started. My name is Neil Bawa. I'm a partner at Financial Attunement. You can see this over to the left. To the right, you can see my handsome picture. Welcome to Fight Club. This is a 1-hour presentation on Chicago versus Dallas versus Kansas, 3 of our famous cities. And we're going to discuss who wins for multifamily and why. All right. So first, important disclaimer, we're not investment advisors. This is an educational webinar. Understand that all investments involve different degrees of risk. Be aware of your risk tolerance level and financial situation. Read transaction confirmations and monthlies and year-end statements. Read prospectuses. Any and all information should be researched prior to investing money with us or with anybody else, really. You're free at all times to accept or reject all investment recommendations made by us. All products are subject to market risk. A recommendation which you're free to accept or reject is not a guarantee for performance of an investment. And we are actually specifically prohibited from guaranteeing accounts against losses arising from market conditions. So don't invest your money on our recommendation alone. This is education. The purpose really here is to learn more about 3 great cities and to figure out if any of them or all of them match your investment aptitude, either as an investor or as somebody that wants to get into real estate and make money. All right, so our goal for today is simple. We're going to talk about who I am, so it's a quick introduction to me. We're going to talk about who the intended audience for this webinar is, why these cities, and my background with these cities, what have I learned there, and how long have I, been working in those cities. How to select cities for investment. This is a general purpose primer on how you can select other cities. Maybe you don't like these, maybe they're too far. In that case, you can select other cities for investment using this primer. We're going to talk about Chicago, we're going to discover Dallas, and we're going to go to Kansas City, Missouri. Now keep in mind, this is not Kansas City, Kansas, as my good friend Joe Torre loves to remind me. This is Kansas City, Missouri. And then bottom line, we're going to compare the 3, and let's fight. Let's figure out which city wins. And then suggested next steps. If this is interesting, it's something that you want to do, I'll give you some suggested next steps for research that you can do. And then I'll open it up to FAQs and questions. Depending on the audience size, I may unmute you guys. But keep this in mind. I love an interactive audience. This means you can ask a question at any point of time. When you use your chat option to type a question in on your side, on my side, a very gentle flashing light is visible. And it might take me some time to see it, but within a couple minutes, I will see it, and I'll answer your question. So you don't have to wait until the end. Just pop, send me the questions as we go along. All right, so about the presenter. So together with my partner, this handsome man here, John Mark Lando, I buy and manage large multifamily complexes nationwide. I have invested myself, and so has John Mark, in both small and large multifamily. So we've dabbled on both sides. We currently, between us, we own duplexes, triplexes, quadplexes, one quadplex. He owns a 6-plex, and we're invested in over 2,000 multifamily units, either as investors or syndicators or both. A syndicator is someone that organizes a large multifamily project and usually invests in it as well. Our properties are in the following states: Kansas, California, Texas, Kansas, South Carolina, Oklahoma, and Illinois. So you notice that all of the states that contain our Fight Club cities, we currently have properties in. So who's this webinar for? 2 kinds of audiences. Number 1 is those that are looking to invest their money for cash flow or appreciation, or hopefully for both. A blended approach is usually the best. And the second audience is for those looking to do multifamily real estate deals, multiple kinds. You can do a buy and hold, you can do a fix and flip. And they're really looking to do it by raising money from other people. So they don't have money of their own, but they want to go find the deals, and then they want to raise money from others. That's our second audience, and we know that there's a lot of members of our meetup groups that are in audience number 2. So next, why did I select these 3 cities for the Fight Club? Well, firstly, these 3 are cited as 3 of the top cities for turnkey real estate. Indianapolis and Memphis are others, and there's a couple others as well. But I don't know those areas well, so they're not in the list. All of these cities have multifamily inventory. So remember, this webinar is specific to multifamily. And these cities actually have multifamily inventory from 2 units to 300 units, though there's usually more inventory in the lower numbers than on the higher side. Two of these cities, Kansas and Chicago, also have distressed inventory. This means REO properties, bank-owned properties, properties that are selling below value. So, I was looking for those sorts of things when I selected the cities. All right. So now this is very important. What size of multifamily is this presentation for? Well, here's what was clear to me when I was doing the research is it's not possible to do a fight club for both large and small multifamily in a single presentation. It will never work. So due to factors, and this is because of factors like inventory and the rate of foreclosure and cap rate, all of these things vary between small and large. So what we decided to do was we're going to target for this particular webinar the smaller multifamily units. So this presentation is duplex, triplex, quadplexes only. Now I must say that a lot of the things that I'm going to say will probably apply to 5plexes, 6plexes, 10 and 20s. Now some of the things I'm going to say are also going to apply all the way up to 500 units. But it's more likely that the stuff that I'm saying for 2, 3, 4 units will probably apply for 5, 6, 10. All right, so next, what's my background with these cities? So I've invested in all of these cities. This is a apartment complex, 248 units in Dallas that I'm invested in. Another one, that's a 384 unit. I've also invested in retail in Dallas, 6-unit retail center. I bought 2 duplexes in Dallas and pretty much paid for them, but the deal fell through at the very last minute because the property did not appraise for the sales price, and I walked away. Now, Chicago, I own more interest in Chicago than in the other 2 cities. I currently own 8 triplexes, 22 units. These are my own. They're not shared with other investors. I oversee 2 duplexes for my father-in-law. Then 4 other investors in my California friend circle who are also a member of some of the meetups that are represented here. They've also invested in Chicago with me. And lastly, I am about to buy a 12.1 million, 237-unit multifamily building. And that's closing on the 4th of November, together with 40 other investors, including some from our meetup group. So lastly, Kansas. Admittedly, I have the smallest amount of background here. I'm currently invested in Waterstone Apartments. That's a 278-unit multifamily. It's in Kansas City, Missouri. I tried to invest in Kansas, but I couldn't really make good connections. So I lately have been hosting a Kansas rehab fix and flip mastermind group at my home. So I know the numbers through them, and I've been consulting one of those folks. His name's Matt Michelson, regarding this presentation. Another one of my friends, Joe Torrey, might actually be present today, at least he RSVP'd. So if he's in the audience, hello, Joe. All right, so next I want to talk about how do we select an actual metro for investment, right? So this has nothing to do with Chicago or Dallas or Kansas City. People ask me all the time, well, if we are looking outside our home city, how do we figure out if it makes any sense? Well, usually we look at 5 factors. These are the 5 factors. Jobs. Is the metro adding both quantity of jobs and quality of jobs, right? That's very important. And you typically want a metro that's adding 1.5% or greater. So 2% would be ideal, but it's really hard to do that. Rent growth trends. Is rent growth robust, past and future? So what's happened to rents in the last 24 months? And what is the prediction for the next 24 months? I love to see numbers that are in the % range, for instance. All right, I have a question here. Joe is here. Joe says hi. Hello, Joe. All right. So back to the presentation. Rent growth trends. Then I look at supply and demand. This is very, very important. So this is one of the secrets of multifamily. So I'll give you an example of Chicago, because recently we've been doing more research in Chicago, but Dallas is a perfectly good example for this. So Chicago created 55,000 jobs last year and 60,000 jobs this year, okay? So at a ratio of 3 people living in an apartment to 1, you essentially need 20,000 units. Well, how many units did Chicago create last year? 6,500, right? Now, keep in mind there's also some inventory left over from the recession, so that's being absorbed. But when you compare the fact that rents went up 3.5% in Chicago last year, you would think if the vacancy, with rents going up much faster than the usual 2%, shouldn't the vacancy be dropping, right? Or vacancy should be increasing, occupancy should be dropping. Well, vacancy also dropped. What does that point out to? A supply-demand imbalance. So we look for supply and demand imbalances because that massively accelerates rent growth and depresses cap rates, both of which are really good for investors. Sales trends, right? So our price is going to increase as inventory tightens. We want to see some evidence that it's already happened. The worst thing that you can possibly do is go into a metro when you think it's turning around. Don't do that. Let some people take the early cream. Do not go into a metro unless there's clear evidence that the turnaround has already happened. And then cap rates, right? So there are a lot of metros where you will see awesome numbers for the first 4 and really awful numbers for the 5th. So if all 4 of these things happen, usually this number really sucks. It's very low and you get very little cash flow. So the moral of the story is not to go into the best metro in the United States, because if you do, the cap rates will be awful because everyone else is already there ahead of you. What you're really looking for is something that's in the top 1/3 of the market, because then you're still early enough for the cap rates to be not too low. Got it? So I'll give you, and I wish I had the time to do this for all 3 of the metros, Chicago, Dallas, and Kansas, but in a 1-hour presentation I can't. So I'll give you an example of all of these just for Chicago, right? So here it is for Chicago. Payrolls are expected to rise 1.3% in 2015, 60,000 jobs. Last year was 55,000. So now we've got 60,000, 55,000, that's 115 jobs. Let's divide that by 3, and we're roughly at 40,000 units, right? That's what we should be creating, maybe a little less. So we'll say, how about 20,000 units being created? That would hold the rents fairly steady. Well, let's look at the next few slides to see how many they're actually creating, right? And here's, by the way, something else I look for: elevated hiring in the tech sector. What does that mean? A tech sector job is worth 2.5 regular jobs because they get paid 2.5 times as much. So they tend to have a very drastic effect on rent prices and cap rate depression. In the Bay Area, everybody who knows about the San Francisco area knows what kind of havoc this has played with the local economy in a good way, but rents have gone up incredibly fast and cap rates have depressed all the way to 2-3 or even less. So those are the sort of things that we look for. And then we look for rent trend, right? So you want to see trends to be higher than 2%. Well, Chicago, for instance, 3.3, 3.5, those are wonderful numbers. So, what I'm about to say may not make sense, and there isn't enough time to go into the math of it. But if the metro you go into, and you pay a reasonable cap rate, maybe you pay a 7.5 or an 8, if rents go up 3% a year for 5 straight years, your investors will probably double their money. And I know this doesn't make sense because it's like, wait a minute, it's only increasing 3%. By simply increasing 3%, how can you possibly double your money? And the answer is there's a lot of factors there. Number one, it's compounded growth. So 3% straight for 5 years is actually 17 or 18%. Number two, usually you don't buy a deal in cash. You use leverage. So the investor's money in a $10 million deal is usually $2.5 million. Doesn't this mean that if the property increases from 10 million to 12.5 million, they've doubled their money? So the increase usually does not have to be double the selling price. Usually a price increase of 30% for the selling price means a doubling of money. Okay, hopefully this makes sense. If it doesn't, send me an email. I'll explain better. So here's supply and demand, right? So last year they did 6,500. This year they did 4,500. So that's 11,000. But aren't they producing in the same time 115,000 jobs? So divided by 3, isn't that something like 40,000, right? Or maybe 37,000. So even if I drop that to half the number, and that's still 18,000 apartment units, and they're building 11. So what is happening? A supply and demand basically mismatch is happening, and that's good for you. So here, this shows, this is actually a confirmation of that. Firstly, there was a roughly 0.7% reduction in vacancy. For a metro of 7 million people, that is a very large decline. Now, after that, they're saying it's going to dip again, even though there are 3.5% rent growth, which is really high. It's still going to dip again. Why? Because there's just not enough inventory in the marketplace. So those are the sort of things we look for when we go into a metro. Dallas is very similar. In fact, in some ways, Dallas is better. It's just the cap rates are much lower. But otherwise, these numbers, the vacancy and supply and demand mismatch is even worse in Dallas compared to Chicago. All right, sales trends. So you see an increase in prices here, right? So from $100,000 a unit all the way to $140,000 a unit. And you might say, well, it seems to be petering out. The answer is not really. These things actually tend to move in multiple ways. So you almost never see this. You kind of see a first curve, and then it tends to slow, and then it tends to pick up again if prices are still reasonable. Chicago prices are very reasonable. So now, and then look at the construction, right? You want to see a large amount of Class A and Class B construction. There's never any Class B construction because a Class A or B becomes a Class C when it's old. So you want to see widespread construction in downtown, and then you want to see widespread construction in the suburbs. Those are all important. Then you want to look for enterprise development zones. Generally, you don't want to buy a property inside an enterprise development zone, but it's nice to buy a property close to an enterprise zone. These are the zones where the city is pumping in money to really push up those areas and make them better. So those are good things to look at, and you can get that information from the Economic Development Council for the city. Crime is very important. Use spot crime. So here's an example of Chicago, right? So I'm buying a property in this neighborhood. What is a neighborhood? It is 1, 2, 3, 4, 5, 6, 7, multiplied by about 1, 2, 3, 4, 5, about 35 blocks. Typical neighborhoods are about 40 or 50 blocks. So this neighborhood has almost no crime at all. This one has some. There's a gunshot here, gunshot there. But is this high? Is this low? Well, take a look by comparison at the wonderful city of San Francisco, currently the most expensive city in America. Gunshot, 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 gunshot. So is this above crime in Chicago high? No, it's actually fairly low. Now keep in mind, if I move that away 2 miles away from the shore, you're going to see a lot of gunshots. So every neighborhood is different, and it's important when you're looking for your properties to look at spot crime and figure out which places are better than the others. All right, so hopefully that was a good primer, right? I mean, just a basic understanding of how we look for cities. Now, I'd like to actually get into the fight. Let's see how these cities are really doing. Let's get into a fight. All right, so I always like to start my fights with pictures. So I'm going to show you some pictures. So this is Dallas, right? So this is it's a fourplex, it's a quadplex. Looks like it's a shingle roof, looks like it was built in about 1980. So typical rental properties that cash flow in Dallas, right? You're going to see something like this. You're going to see a property that was built in the 70s, built in the 80s. And then the inside also, you can see this is a property that's built in the 80s, right? So it kind of looks like that. Fairly straightforward, rehab. Now, Dallas, because the demand is so hot, you do not tend to see new rehab. And if you see new rehab, the quality of the rehab tends to be lower because it doesn't have to be high to rent. Dallas already has extremely low vacancy. If I was rehabbing there, I would do exactly the same thing. This property looks like it's been rehabbed about 10 years ago. So this is not the original 1980s stuff. Notice how clean these cabinets are. So it's probably been rehabbed, I'd say, 5 to 10 years ago. So that's Dallas. That's what Chicago looks like. And you might say, holy crap, it looks gorgeous. Well, the answer is there's more competition in Chicago. So obviously, when there's more competition, and on the part of the the renters, they've got more opportunity. They look at other, a lot more units. Whenever a property in Chicago is rehabbed, they tend to put more money into it. So this isn't as gorgeous as it looks. It's quite deceptive, actually. This is not granite countertop. It's faux. And this is a little bit of tiling that is quite inexpensive. These are regular cabinets, but the newer ones are espresso and they look nicer. And in most of these places, whether it's Kansas or Dallas or Chicago, you tend to get laminate. I really doubt if this is hardwood flooring. It could be, but it probably is just laminate. So these look very nice, but they're not very high cost. Also, this very much looks like laminate. Doesn't look like hardwood to me. Now, the outside of the buildings in Chicago are ugly. Does everyone agree this is an ugly building? It looks old because it is old. Most rental buildings in Chicago are 100 years old. Yes, I mean, for Californians, some of them faint when they hear that. The answer is this is built with a Chicago common brick, which was invented after the 1987 or, well, 1871 fire in Chicago, which burned down half the city. The Chicago common brick lasts 300 years, which means that 100 years after our homes in California fall down, this is still going to be there. The inside gets rehabbed probably every 10, 15 years. So, the guts are very strong. The outside doesn't look very pretty. But do you care? You live on the inside of a building. So Kansas. So this is what a typical Kansas property looks like. This is a quadplex, garage in the front. Kansas tends to do a lot more frame, though there are many brick homes there. You're more likely to see frame homes. That's this kind of a superstructure compared to something like this, which is brick. Brick is generally nicer and more expensive, but Kansas homes are really inexpensive. They're very low cost. And again, we're not talking about single-family homes, but even the quadplexes kind of resemble the single-family homes. The rehab in Kansas tends to be fairly old in style, so you notice they don't rehab them very often. They tend to do a rehab maybe every 20 years or so. So before I get the Fight Club started, this is very important to note. In the next few pages, I'm going to give you pricing and a lot of other stuff. Now, anybody in 15 minutes on Zillow can find properties above that level and below that level, right? It's easy, right? So if better, if the area is generally better, if the rooms are larger, if for a variety of reasons you can find properties that are better, and you can also find properties that are a lot worse. What we are really trying to compare is cash flowing rental property in B- or C+ working class neighborhoods. That tends to be the sweet spot for most investors that are interested in cash flow. Now, if you're not interested in cash flow, why the hell would you want to go to Dallas or Chicago? The best place for investment is here in California. There's lots and lots of good investments here which may give you long-term return, 10, 20-year return, but they're never going to give you any cash flow. In most cases these days, you're going to have significant negative cash flow. So this discussion is really more about cash flow. I know that our meetup group members generally want cash flow with their investments, which is why we recommend going outside California. All right, now resist the temptation to read ahead because I'm going to explain these as I go. So first I'm going to define what a turnkey provider is. A turnkey provider is somebody that rehabs dozens or in certain cases hundreds of buildings in a particular metro like Chicago, Dallas, or KC. And then they sell them to you with tenants. In certain cases, they even guarantee the rent for a year in case a tenant leaves, right? So turnkey providers are great because many of them do a very, very good job, a professional, consistent job of rehab. But there are downsides of turnkey providers as well. And some of you that may be looking to invest may not want to spend a lot of time on it. And so I wanted to share with you some of the numbers that you're going to hear if you're going to a turnkey provider and also what the true numbers are. So here we go. Here's the first one. Turnkey provider projected returns for a city. So you typically hear 16 to 17% as a standard number for a duplex, triplex, quadplex in Chicago. Dallas, you tend to hear 10 to 11 as a standard number. KC is kind of all over the place. So it's a kind of a wider range. I see 16, and very often I see 20. Sometimes I even see 25 in KC. This really is rare in Chicago or Dallas, but KC, the range is very wide. All right, so next, let's look at actual cash-on-cash returns that you can expect, not including, whatever principal you're paying back. That's extra, because cash-on-cash means it comes into your pocket. Your principal return really back to your pocket. It goes to the bank, so I don't count it. So generally, 12% is a number that I've seen most often in Chicago, though 15 is fairly common, and I mentioned that because Chicago has foreclosures, so obviously for those that are brave, there's more return. Dallas at this point really has zero useful foreclosure inventory. So 12% is what I see in Chicago. And what's the difference between these? Why is it that they say 16 to 17%, 17 most of the time, but they deliver 12? Well, and you may want to write this down if you're actually looking to do this. Number one, almost always the vacancy number is wrong, okay? In Chicago, for example, the vacancy number is not 5%. You'll even see 4%. Those are all nonsensical numbers. The real number is either 9 or 10, depending upon the area, which means that 10% of the time your property is going to be empty, or you won't get rent for some other reason. The second one is maintenance. In most cases, they mention 5%. Well, in areas that use Section 8, which is not Dallas, but often for KC or Chicago, Section 8 requires annual maintenance inspections, and when they come in and do inspections, they make you do all kinds of work. So the true maintenance number is either 9 or 10, depending upon the area. So those two bring the numbers down. Also, leasing costs. Very often, nobody tells you that when a tenant leaves and a new tenant comes in, there's going to be a leasing cost. And this leasing cost is a bit lower in Dallas and then higher in Chicago or Kansas. And generally tends to be a month's rent. So the property manager or his external leasing agent will charge you that fee. You never see those things in pro formas, and you should. So once you factor in all of those, 12% tends to be more common. Though, as I mentioned, I know of lots of deals in Chicago that are 15, but that's just because of foreclosure inventory. Chicago, this is 2015 or maybe the beginning of 2016 is the last point at which you get foreclosures, and then they're done. Dallas doesn't have any left, though they did until the beginning of last year. KC has significant inventory in the foreclosure area, so in those areas I'd probably think KC would also be 15%. Now, next let's talk about annual appreciation. This is, how much is my property appreciating in value? Now, Chicago tends to be low, and so does KC. 3% numbers are fairly common. Dallas tends to be high. In the past 5 years, it's been higher than 6%, or I would say past 3 years. But going forward, appreciation is not straight line. It tends to basically go up fast and slow down. I think 6% is a more reasonable number. But a lot of people will challenge me and say, no, that's too fast. Dallas doesn't traditionally go up at 6%. It's much lower. And my point is, things have really changed. Dallas is becoming the new California, and so it's likely to have higher annual appreciation for a decade or more. That's my feeling. Total annualized returns, and this is my best guess, is really this number plus this number. So 15% for Chicago, 13% for Dallas, and about 13% for Kansas. Now, note for Kansas, sometimes this could be as high as 20%. So remember, Kansas is the one that's really variable. It's sort of all over the place. So that number is probably an average number, but you might reach as high as 20. All right. So now I'm going to talk to a different audience, right? So these are folks that are looking to invest their money and buy duplexes, triplexes, quadplexes, and hold them. Either they're buying it with their own money or they're raising money. But what about people that want to do flips, right? So first, a comment. Remote flipping is for brave people. Truly make sure that you have the time for it. It's for brave people. Having said that, here are the returns. Chicago has much higher returns, so you can easily make $40,000 in a flip project for a duplex. Dallas less because there's less inventory, so there's more competition in the rehab world. So 30K is still a little tough. I'd say 27, 28. Kansas, you can get 20K for a duplex. you can actually make more money, but the problem in Kansas is selling times are longer, so it takes longer to sell, and that tends to eat into your profit. If you're lucky and you sell early on, this number could very easily bounce up to 30 or more. So again, these numbers are all for multifamily, and it's very important. Now, I'm going to keep saying this, that these don't apply for the single-family markets in these areas. Now, some people don't want to do rehab projects. They're lazy, and they're also very smart. They want to do what is known as private lending. I don't have the time to tell you what private lending is, except that it's pretty awesome. But what they do is they become the bank for rehabbers, because most banks will not lend on a property that's gutted or a property that needs to be gutted. So there's this private lending business where people lend to rehabbers. Chicago has a very active, very robust private lending business. 14–15% returns are fairly common. Dallas, I'm being a little generous with 12%. You probably will end up making less money than that. KC, 12, 14, maybe even higher. So KC is again a little variable for returns for people that want to lend their money out or lend other people's money out. All right, moving on. Eviction process. So Chicago, no, not fun. Not as bad as California, but 90 days. Dallas is straightforward, 30 days. Kansas tends to be 45. Now, that, Joe Torre has his units there, so I'll, ask him to comment on this. But from the information that I found, 45 seemed to be a fairly common number. All right, moving on. Price per unit. Now, before anybody jumps on me from a chat perspective, these are comparables, right? So if you want more fancy units, all of these prices go up. If you want ghetto units, all of these prices go down, right? But comparable units, 80 to 85K per unit is the price in Chicago, especially for those nicely rehabbed units that we looked at. For Dallas, the lower level of rehab units that we looked at, 70 to 80K is a price. But again, these are working blue collar areas. In Dallas, there are lots of areas where you pay $250 per unit, but those are B+ or A areas. Crime, and you can use spotcrime.com, is medium high in Chicago, medium low in Dallas, and medium high in Kansas. So the first and third cities are similar. Dallas is lower. Delinquency, again, is medium high in Chicago, medium low, and fairly high. Kansas City suffers from fairly high delinquency. Delinquency is people paying late, or you having to chase after them to get your money. How long to sell a property at market rate? So Chicago takes about 3 months to sell a property. Dallas takes 30 days or sometimes 30 seconds because it's a very hot market. And Kansas City can take a long time to sell. 90 to 180 days is fairly common. Volume of the smaller multifamilies, how much inventory is in the market? Basically, this is just large, medium, small. So there's quite a bit of inventory in the Dallas market for 2, 3, and 4 plexes, but there's more competition. So you're going to have to close very quickly and sometimes offer a little bit more than this to get those units, which is why the cash-on-cash returns here are lower. Price competition is fairly low. In Chicago, you're not in a bidding war against 6 guys. This is very high for the last 6 months, but in general, Dallas tends to be medium in terms of price competition. Kansas City has very low price competition in most cases. Long-term rent growth, I would say Chicago has been 2%, and so have Kansas City. These are fairly good numbers. Dallas has been 2%. I don't think that's the case in the future. I think it's going to be 3%. So, more fights. Property management quality, you get decent folks in Chicago. You get really the best of the 3 in Dallas. You get poor property managers for the most part in KC, and the reason for that is the per unit revenue in KC is significantly lower than the other 2 metros. So you tend not to get really high quality folks. Having said that, I'm sure there's plenty of good property managers. This is just an average, right? You're just trying to compare average numbers. Average tenant occupancy is 2 years for Chicago and Dallas, about 18 months for KC. And the jobs added by metro, I put this in, but it's hard to really compare because Dallas really is a lot better than Chicago because these two metros are the same size. So while Chicago produced a truckload of jobs, Dallas did even better. I believe it was #1 in the U.S. KC is a much smaller metro, so the 13,000 was really about a 1% population growth number. Not as good as Chicago, and certainly not as good as Dallas, but not horrible. Okay, so time for the bottom line, right? You want to know which city is winning. The answer is it depends. There are 5 different factors that people should look at. So what I've done is I've got 5 different winners. There we go. So appreciation. If you're strongly biased towards growth and appreciation, Dallas wins easily. It's not even close. Long-term hold. Once again, Dallas wins for a much longer-term hold, 6+ years, because rents are likely to go up faster. Remember, 3% versus 2%. So if you're doing a very long-term hold, Dallas is going to win. Cash flow. If you're biased towards cash flow, Chicago wins very easily. Again, not even close. Private lending and rehab. If you're looking to become a lender with your money or other people's money, or looking to do rehab projects, then private lending is more profitable in Chicago. Truly horrible in California, where people are only paying 10% for private lenders. That's a lot of risk for 10% return. So also rehab projects are much better in Chicago, and these two items are actually linked. The reason that you can get more money as a private lender in Chicago is that the margins are higher for rehab. So the rehabber can afford to pay you more money. So these are all connected together. Scalability. If you are not the kind of guy that wants to buy 1 duplex, if you want to buy 8, like me, I hold 8 triplexes, well then Chicago is better, because try to do that in Dallas, it's going to take you 2 years just to get to 8. Where in Chicago, you could probably close 8 of them in, 8 months. So more inventory, lower competition. Chicago is better for people looking for scalability and large growth. So now what about Kansas? I mean, Kansas City cash flows well, but the problem with delinquency and the illiquidity, which means it takes a long time to sell properties, can really affect returns fairly significantly. Plus, KC seems to grow slower than either Chicago or Dallas, so rent growth could reduce over time. Now, this is very important. Everything I just said was for multifamily. If this Fight Club was for single family, there is a strong chance that Kansas City would win. But to be honest, I don't know single family well enough in Kansas. It's just a gut feel that it might win. But we're doing a multifamily analysis, and that's where I'm strong. So we'll give Kansas a runner-up award there. Having said that, this is not a single family Fight Club. So hopefully this gives you an idea of where to go, right? It's really dependent on what you're looking for. So 2 wins for Dallas, 2 wins for Chicago, right? It's really up to what you want. If cash flow is really important to you, go to Chicago. You're going to give up on some growth. If you can take a 7% cash flow instead of a 12% cash flow, then Dallas is the better place to go to. All right, so if this is interesting, here are some next steps that I can suggest to you guys. Number 1, do your homework. Search Google for turnkey real estate and then whatever city you're interested in. Then talk to a few of them, not 1, 2, 3. Do not trust the profit and cash flow numbers. They're not right. But keep them in mind. It's useful to go through the exercise. It's very beneficial. Then discuss some of those numbers with a knowledgeable real estate mentor. So some of you can work with me fairly closely. You can talk to me. Others, find a local mentor. Isn't that what the meetup group is for? Then decide what kind of investment are you really interested in. It's important to write this down. Do you want to invest passively in large multifamily? Right? Chicago's a great market for that. Do you want to buy your own 2, 3, 4 unit? Well, both Dallas and Chicago are great. Do you want to rehab, or do you want to buy a stable unit? A rehab unit, it takes a lot of effort and time compared to a stable unit. Do you want to lend your money or other people's money to rehabbers? What is it that you're interested in doing in real estate? First, figure that out. Once you figure that out, think about where the money comes from. For large multifamily, the money really always has to come from you, because you're buying a partial share in multifamily. Many people can afford to buy their own 2, 3, 4 units. Like me, I own 8 of these triplexes in Dallas, in Chicago, I'm sorry. Well, you buy from a turnkey provider. My first one was from a turnkey provider, and then the other 7, once I figured out the game, I bought from market. So rehab projects actually require both money to buy and money to rehab. So figure both of those things out. You can also raise money from others, and you can do that to buy, to rehab, or to lend. So think about which of those things you want to do. Oops, there we go. Then think about the time investment. This is what most people ignore. So I urge you not to ignore point 5. Time investment is very key for anyone that has a day job, because you'll find that you will actually end up eliminating stuff on the basis of time investment. So for large multifamily, it's completely passive, so there's no time investment. To own your own 2, 3, 4 unit, you will need to spend considerable time when you're buying from the market. Buying from a turnkey provider is simpler. You'll get a lower return and you'll pay more, but that's okay because you're getting a return compared to the darn bank that pays us 0.25%. Rehab projects are actually quite profitable, especially in Chicago, but take a tremendous amount of time and multiple visits to the metro. So yeah, they make a lot of money. Yes, the money comes quick, but there's a lot of challenges: time, visits, and oh, one more challenge that I didn't mention. So you have a day job, right? What if you make a lot of money in your day job? You're now adding that rehab's profits on top of that. So you're likely to pay a heck of a lot of taxation on it. Now you're going to pay much less taxation when you own large multifamily, or you buy a 2, 3, 4 unit and you hold it for more than a year, because those are capital gains, right? So those are taxed at a lower number. Now, if you're lending money, visits are usually not needed. The money will still get taxed as ordinary income, so keep that in mind. So these are all the different time investment factors that you should think about. And the last thing is, think about your approach. Fix and flip equals more time, more effort, quicker money. You want to buy and hold? Well, it's slower. And where do you want to buy and hold? Do you want, do you need cash flow? Do you need future appreciation, right? Do you want a fractional share in a large multifamily instead, where you're not doing any work? Do you want to lend money? So now, having thought about all these things, think about your approach and finalize one. And then the last thing is, if you don't want to do the research that I strongly suggest you do on Google, then in that case, I'll introduce you to turnkey providers and fix and flip companies and rehabbers who need a private lender. So if you're looking to lend money, you talk to these guys. If you want to partner with somebody and flip properties, you talk to these guys. I know a good fix and flip group in Kansas, for instance. I know an excellent one in Chicago as well. I don't know one in Dallas. I do know turnkey providers in all 3 cities. And I know plenty of rehabbers who always need private lenders in case you have money to lend. So I'm happy to do that for you. Write this down. This is my email address. Just drop me an email. I'm sorry I cannot give everyone in this seminar a phone number, but I'm happy to respond to your email. So that is that. And we actually ended 11 minutes early, so I'm happy to take any questions. If anyone has questions, now is the time. Any questions? Sam, Mike, Shazad, Terry, Michaels? Wow, I must be doing a fabulous job, or a terrible job, I'm not sure which, to get no questions. All right, we'll give it another few seconds just in case. Oh, there we go. Do you think KC will improve now that Cerner is building a new campus? Yeah, I certainly think so. I think that KC has good opportunity around the Cerner campus. I believe Cerner is bringing in a total of 27,000 jobs, some of which are already in KC. So the answer is there is significant opportunity around the Cerner area, no doubt at all. Michael DeVries asks about, have you looked at Raleigh, North Carolina? The answer is, I looked at it a while back, and it was a wonderful metro with low cap rates because of its technology base. So I've actually been to Raleigh because when I used to have a day job before I retired, I had my company worked with Cisco, and they had a installation there. Very nice city, pretty awesome. Cash flow is an issue. Question from Sam. Oh, just a thank you. Oh, you're welcome, welcome, Sam. This is great fun for me. Question from Shazad. Any tips on funding such deals? The answer is meetup groups. I find money in meetup groups all the time. So build your network. Today's meeting, unfortunately, you can't really, mix. But in your city, there's a dozen cities represented here today. In your particular city, our meetup will be having face-to-face meetings as well. So Joe also mentioned that the Cerner campus is a $4.5 billion campus. As I said, there's no question in my mind that there's opportunity in the Cerner area. Grant asks, are there good banks in Chicago that will lend to an LLC and more than 5 loans? I don't see why not. Personally, I have 10 loans and my wife has 5. So it's usually more than 4 that's the issue, not more than 5. So if you've gotten 5 and the cash flow in the property looks good, I don't see a reason why you would not get more than 5. Now, in most cases, though, banks would want you to be on the note. Most banks will not allow an LLC to be on the note. Now, some might allow both you and LLC on the note. So hopefully that answers your question, Grant. So any thoughts on Atlanta? Joe, I have missed the boat on Atlanta. I am deeply angry with myself. I think Atlanta has done phenomenally well, and there's still, I mean, despite the incredible rent increases in Atlanta, there are still reasonable properties there. But unfortunately, there's a lot of scams going on in Atlanta as well. So a lot of the turnkey providers are, let's just say, not very ethical. So you need to be careful with Atlanta. But as a metro, I am amazed at Atlanta. I'm amazed at the rent growth. It's spectacular. So Shazad asks, is it better to have professional property managers for fewer units, or you can manage them on your own? Well, if you don't live in that metro, you really have no choice. You must get them. They are a pain in the butt. And you unfortunately just have to deal with it. The reason why I generally am selling my small multifamily holdings, whether they're in California or elsewhere, is because they're a pain. All property managers are a pain. You make money, but it's tough to deal with them. The only way to get away from it is large multifamily. But then keep in mind, large multifamily is no magic either. When you invest in large multifamily, you're giving up control, and large multifamily tends to be illiquid for 2 to 5 years, or same thing with large commercial. It's illiquid. So if you can bear the illiquidity, probably your best returns will come by investing in large multifamily. And granted, I'm a little biased because that's what I buy. That's the sort of investors I work with. But in my own investments, and as you can see, I buy a lot of different levels. That's where I've seen the best returns. If you're going to buy small multifamily, it doesn't matter. Even if you have a property manager, you are going to kind of be the landlord, and you just have to live with that. All right, next question. Mike Allen, what surprised you the most when you analyzed these cities? Well, for Kansas, what surprised me was how much of a difference there was. People were selling all over the place. The returns were all over the place. Prices were all over the place. Chicago, what surprised me was just how much of a variance there was from the number, the profit that they were stating, and the real number. I always see pro forma as being a little inflated, and I understand that, but these were ridiculously inflated pro forma. So that surprised me a little bit, because to me it seems like if you do a little bit of research, you're going to figure out that these are all wrong. But maybe people don't. Obviously, nobody's going to keep making pro forma if nobody buys. But it's surprising. It seems like their sales pitch actually works and people don't do their due diligence. Grant asks a question. When visiting these cities for the first time, who do you recommend we make appointments with to get a good idea of if we want to invest there? Well, a number of different people. One is just make some, figure out your area first. Like, for example, Chicago, you can only invest in the south side if you want cash flow. The north side is kind of like California. There's no cash flow there. You're going to get much higher appreciation levels, probably not as good as California, but then you're not buying, something for $1 million. You're probably buying something for 250. So it's got to be the south side. South side has a lot of neighborhoods that are not good. They have crime. So you really need to do your research on zip codes and neighborhoods first. And then when you've done that, go to Zillow or Trulia or Redfin. Redfin is my personal favorite, and find agents that serve those areas and tell them you're coming to Chicago and that you like to be walked around a bunch of different units. So that's a good place to go to if you're doing 2 to 4 units. Keep in mind, the moment you switch to 5 units, you are not going to be calling those people. You have to call a completely different agent, a commercial real estate agent, and those are available from 2 websites, Remax Commercial and KW Commercial. So that's remax.com, and you click the commercial link, or KW Commercial, and you can find those agents and talk with them. Hopefully that answers Grant's questions. Wow, that's it. That's about a dozen questions. Any more? A last question before we close? Going once? Going twice? Gone. All right. Thank you, folks. Those were wonderful questions. I archived this webinar, so your questions are archived as well. And if you have folks that would like to see this webinar, send me an email and I'll send you a link. It goes up on the Financial Attunement website. It's a YouTube link, but you have to watch it through the Financial Attunement website. And you're welcome, Shahzad. You're welcome, Michael. I enjoy these presentations. They're great fun. So I hope that in addition to looking at properties in California, you guys will look outside. There are a lot of benefits to areas outside California that you cannot possibly get in California. I don't see that changing in the future either. So take a look at this stuff, do some research, make sure you do your due diligence, and figure out which approach you want to use. Hopefully this has been beneficial. So good night from Neil and from Financial Attunement. Thank you for your time.